Some of you may know Mark Skinner. Mark is with the Highland Group. He heads the Highland Group, is the president there. Mark is one of the foremost brain trusts, if you will, on statistics within the Extended Stay Lodging Association. I talked to Mark and he had offered us a few slides to talk on an overview of where we are today from a mid-year standpoint in extended stay. Now the interesting part about it is what goes behind us is not what goes in front of us. So some of the material, some of the data, some of the definitions no longer will exist as we go forward. And we will explain and talk a little bit about that in the ever-changing aspect of Extended Stay Lodging Association, Extended Stay segment. Okay. So, let's see. So let's take a look at what was the definition, even last year, of extended stay market of hotels. As hotels with a fully equipped kitchenette in each room which accepts reservation and does not require a lease. We'll talk how that definition is changing, especially with the emergence of so many new brands. But this, in fact, is how these statistics that you're going to see were developed with brands that meet this criteria. So a little over 571 rooms currently in the U.S. as of this June, but only represents 10% total of the U.S. hotel rooms, amassing a little over $14 billion in revenue in 19, a significant drop though in 2020, but then back right up in 21 and continue to grow nicely into 22. And mid-year 23 is about 9% up mid-year over last year, year to date in 22. Okay. So it speaks to the resiliency. I know that in our products, and we were very fortunate, let's say, to run an average in our extended stay products of about 90% occupancy. Throughout COVID, we were running 73, 74%. Still making cash flow, still keeping everybody employed. And we'll talk again more about the resiliency in the market itself. Within the market, though, there are a variety of upscale, mid-price, and economy. And again, these definitions are what was, not necessarily what is or what will be as we go forward. But it was defined upscale as above $135 average rate, mid-scale in the 75 to 135, and then economy under the 75 market. You'll see, even though this looks like a lot of product, we will talk about the new products coming into the marketplace over the next year or more that actually have recently been in the market and now have quite a development pipeline going forward, which you'll see things will blur a little bit as some of what would be otherwise known as economy brands are running well into the 75 to 135 range on a daily basis, and the brands that actually run under $75 will be somewhat more limited. That speaks to the strength of extended stay, it speaks to the average rate power of extended stay, and how it's meeting certain demands that were not met prior by the other 90% of the hotels that exist. RevPAR ratios. In 1990, they were running about 80% RevPAR within the economy section. Now, they are over 96% RevPAR index in the second quarter for all extended stay economy products. Now they differ, and you'll see in a moment how they differ from economy to mid-scale to luxury. In the mid-priced area, it was about 93% occupancy in 19, and now it's about 104% RevPAR index. Significant growth in the past year. Okay. Move back here. I may have skipped one. Mid-priced. I did not. But let me tell you that luxury is actually following the mid-price and even higher in the RevPAR index. So the products that are running in excess of $135 average rate are dominating in the marketplaces, up to 110% on average as a RevPAR index across the system. Okay. So that gives you a little bit of where we have been over the past year, and the panel will talk about where we are today and where we are going. I thought of this phrase last year, and I'd like to offer it to you, and maybe it'll stick, we'll see. But the secret to some is now the secret to none. Okay. Extended stay is the hottest segment going today for a number of reasons. And so, panel, let's jump into our questions, if I may. And so, let me start with what really makes, because in this discussion it's fair to have a baseline of what makes extended stay its own segment. Why, in fact, is it different? So, Dave, let me start with you, if I may. And from any standpoint, how do you see extended stay being a completely separate market from other hotel-style brands?
Well, I think just by the nature of a transient hotel versus an extended stay hotel, I mean, obviously the length of stay, but everything changes. Your labor model changes, your margins change, right? So I like the quote that you just said, and repeat it again. The secret to
The secret to none,
none
is
is
now
now
the secret to some is now a secret to none.
And so when you look at what happened with the pandemic really validated what the secret sauce of extended stay is. You know, you had hotels that were running in the mid-70s occupancies, but yet the owners were still making a lot of money. What's the major difficulty of a lot of hotel owners right now? It's labor, right? So if you look at extended stay, whether it is mid-scale, upper mid-scale, or especially economy, you're running it from anywhere from 5 to 7 FTEs all the way up to, with a stay average maybe 20, right? And so owners started really looking at this segment as an alternative to the traditional transient hotel industry. Almost where you can operate this as a short-term rental when you're looking at the economy space,
Right.
and have margins that are close to 65%. Now, I don't know any hotel owner in this room who wouldn't want to have 65% margins.
And let's just stop for 1 second. If you look at the various segments for a moment, so a full-service hotel, and again, give or take markets, this is not a perfect number, but maybe running somewhere around a 17-19% GOP, gross operating profit. And after fees and taxes, whatever, somewhat less. A limited service product probably runs into 27 to up to 38% GOP level. And then a little bit less after expenses. The extended stay model generally runs in the 40% to up to mid-60s. Okay, so even with that, and I can speak from personal experience, that the net NOI in many of the hotels that I have exceed 30% cash on cash. Okay, so as Dave was relating, the performance is significantly different, and by itself, and there are a variety of reasons Dave mentioned about the staffing model, is completely different, but there are other aspects of it.
Yeah, but Doug, even before you go there, and what Robert said, here we are representing extended stay. Within extended stay, there are so many different segments. How the economy extended stay world operates is very, very different to what extended stay was 10, 15 years ago and what Staybridge residents in it. So you've seen an evolution in the segmentation within the extended stay that really validates what the entire model is.
Doug, what you're saying about the secret to none, when I first joined Value Place, we used to always say we were the best kept secret locker because it was a sort of a segment, economy extended stay. It was a niche segment. Not a lot of people wanted to get into the segment because they had sort of a misperception of what it really was. But over time, I think really the evolution has been the key. Extended stay is not a glamorous segment, like to say. There's nothing glamorous about extended stay, except for the returns. That's really where the glamour comes in, right? And I think what people forget with the extended stay, the reason you want to invest in this segment, the reason it continues to attract so much capital, end of the day, extended stay is good for guests, but it's actually better for owners because of the low employee count, the low cost operating, the demand supply balance, everything's set up. And with, I think, two kind of turning points in addition to the pandemic was when Choice Hotels reached out and they purchased Wood Spring Suites and they kind of made a statement that we're going to invest in extended stay. That really, I think, began to put extended stay on the map, and as people saw the success we're having with the growth and with the repeat owners going in, that sort of acted as an accelerant to bring the segment toward us today. So we went from the best kept secret that it's fair to say the hottest segment in lodging. It's sort of evolution over time.
Well, I think it's worth mentioning, though, the representation on the stage is quite phenomenal, to be honest with you. I represent Homewood Suites, Home 2 Suites, and our project H3, which is our pure extended stay play. But if you look at Homewood Suites, our average length of stay is 3.1 nights. If you look at home 2, the average length of stay is 2.9 nights. On any given night, we've probably got anywhere from 44 to 34% of available rooms attributed to extended stay. But the magic is, why I love and fell in love with the segment, is because 5 nights for us is defined, or extended stay for us is defined as 5 nights. There is no trouble in this industry filling up on a Tuesday, Wednesday. Anybody can do that. But for extended stay, you have to arrive on a Sunday, you fill a Monday, and you fill a Thursday. And that's the magic of this business, if you are disciplined to execute extended stay as a business. But you have to be disciplined to do it. You cannot run an extended stay asset as a transient asset. You don't have the labor pool to do it. So I love the discipline behind this industry. All of you guys do an exceptional job of managing the discipline within your respective segments.
Yeah. And Doug, I love that because even what Rick just said, the definition of what he just described is extended stay occupancy is different. We actually describe it as the percentage of occupancy that is 7 nights and higher. And so for our brand, Favorite Suites, that's generally around kind of 50 to 55% of every night's occupancy is attached to someone who is staying at least a week or more. And for Kenwood Suites, it's 60 plus. And so even the way you think about managing the business is different across brand companies. And I think I just want to hone in on what we started to talk about in terms of labor models. And so for a brand like Kenwood Suites, you're typically talking about 10 to 13 FTEs. And as you distinguish between those brands, there's probably 3 areas that you look at. One is sort of the amount of, I'll call it departmental leadership you need. That sort of differs from economy up to, you know, where we play in Homewood, Residence, Favorite Suites. Then there's amount of housekeepers you need, which is dictated by how often you clean the rooms. So on Kenwood Suites, we intentionally don't touch a guest's room for 7 days, right? That means there's less stayover cleans, and if you're running high E-stock, there's less checkout cleans. For Favorite Suites, we do late light touch housekeeping Monday through Friday. We do your full clean on the weekends, and so that also changes the amount of housekeepers that you need. I think the last is, at least in terms of the upper part of the market, is how much F&B labor that you have. We offer a complimentary breakfast 7 times a week on Savers, along with an evening happy hour. That just sort of gives you a sense of how to pull apart some of these labor assumptions in terms of departmental leads. And then some brands, it really differs on whether you have a director of sale on property or whether you're getting a lot of your business fed by above property. And so these are types of questions we want you to kind of ask us during the reception as you peel apart how staffing models are dictated by the brand.
We're rolling into a variety of areas, just trying to bring us back here a touch, because Justin's absolutely correct. But at lunch we talked about hotel brands giving less, charging more, okay, getting further away from the guests and their needs. It's different though in extended stay. Each of the brands that have created these particular models, like a Canada or a Staybridge, have done countless hours of examining what does the customer want. If you're going to stay somewhere for one night, what do you want? You might want to get in quick, get out, you want a comfortable bed, you want a few different things, and that's it. Let me go and do my business. If you're going to stay somewhere 7 days, 2 weeks, 3 weeks, in some cases a year, okay, your needs are different. Not only from an amenity standpoint, but how the greeting is. Do you want this residential feel? So I think that although the brands are different, have different labor models, have different offerings, it's not how little can we give the guest, it's what's important to the guests. And therefore, those amenities are spot on. And that's why they have the highest satisfaction level anyway for guest comments, is because you're giving the customer what they want, regardless of it is pure economy or more in the higher end luxury markets. The GLPs and the profitabilities remain relatively the same. It's pretty remarkable.
Yeah, Joe, it's interesting. We had a conversation prior to jumping on the stage about that. And one thing that should have come up maybe over lunch is about choice and control. You have to give the consumer choice and control to dictate their journey. We need to provide them what they need in order to take their journey. So for example, we rolled out a prototype at Homewood Suites in April of 2021. We listened to guest feedback, and some of the things that we introduced are things like a low labor bar solution, which is a tap wall, where a guest can buy an RFD card, pop it in, and draw themselves 12 ounces of beer. That's your choice. But I want to provide you with that as an option when you stay at Homewood Suites. Elevated retail. partnerships with places like Grubhub. So I think as an industry, we need to afford an extended stay guest the same experience that they would experience at home, but in our environment. You can't dictate their journey, they'll take their own journey. We just need to be there to engage with them along the way. I mean, you can check into a hotel now remotely. I don't have to talk to anybody anywhere. That's not hospitality for us. So for us, we would like to create engaging moments where it almost forces the guest to have a moment with us, because that truly is hospitality. And I think to some degree we've got to give them the choice and control to dictate their journey, but you have to engage with them. These are extended stay guests. I would hate to lose an extended stay guest for 30, 60, 90 days. Have them check in, have them check out, and then have a conversation. Good Lord above, that's not hospitality. It's our job to dictate that, and these guys all do a great job of it.
That's a great point. It's also equally as important to talk to your owners and developers and operators to see what works in their model as well. You know, what works in an upscale extended stay may not and should not work in an economy extended stay. So, you know, the models are very different. You know, I think if you were to compare whatever segment you're talking about, whether it's economy extended stay versus economy transient, the margins are always going to be higher in the extended stay, right? Same thing with mid-scale, upscale. The margins just grow when you're more in the economy segment because, you know, there really aren't many amenities in Echo, our new economy extended stay. You know, we don't have a front desk that is open 24 hours a day. It closes after 8 p.m. or 10 p.m. and opens up at 7 a.m. There's a reason for that. You know, our guests and what the guest is wanting at that facility is different than, say, our Hawthorne Suite or Canwood and Savory.
Is good hospitality what we think, or is it what the guests think? I gotta tell you, it's what the guests think. Because if they're satisfied and they're happy, they're gonna come back. They're gonna choose your property because you provide their purpose-driven reason for why they're in your property or why they're in the area.
Yeah, I think with, like for Woodspring Suites example, it's going to be a different expectation than the homeless referrals. What they're looking for, mainly looking for clean, safe, and affordable. If you can deliver those, there's so much demand in that segment, you will run a really high occupancy. In fact, talking about the labor model, we don't have a director of sales for Woodspring Suites. That's something that GM does because, frankly, there's so much demand in that segment that's not a requirement, so we take it off the labor line. So. And then in addition, as they were saying, we want to drive occupancy because the longer, there's a direct correlation with the length of stay and profitability. The longer a guest stays, you can have a guest stay at an economy extended hotel for over a month, the labor cost for that guest is going to be under 2%. And that's really where the magic of the returns come in with those long stays at these properties.
And to your point, it takes discipline. You know, it takes a lot of discipline. Some of the best upscale transient owners might not be fit to operate in Woodspring or Echo. It takes a lot of discipline to say, listen, I'm not going to sell the room for $400 a night because the cotton wall's in town. Because I might displace someone who's trying to book it for 30 days.
I've never seen average rate go in the bank. It's profit. And, you know, it's interesting to me anyway, because I think that extended stay owners are more entrepreneurial. It's not about telling your family or friends what you own. It's really about the investment, as well as the fact that you are making a lot of people happy all the time. You know, the front desk knows their names because they're with you for 2 weeks, 3 weeks, a month, whatever. They know your pets, okay? It's really interesting phenomenon. Hokey is not a bad thing in a residential field because you become like family in many cases.
Yeah, so Jack DeBoer, who founded Value Place and founded Residence originally, he had a really famous saying he'd share with us. He would say, if you're at the country club or out to dinner with your neighbors, talk about your upper rate scale hotels, talk about your great brands that you have there. With your bankers, he would say, show them your clean house or your Woodspring Suites and your Value Place. That's really, it's about entrepreneurs who are really focused on, again, it's not a glamorous segment. It's not like you don't get a chance to put a lot of your personal finishes into these properties. It's very standardized, very scalable, but the glamour is in the returns that you get.
But we talked a little bit about that there are a lot of new grants coming in. You know, be that Residence Inn has Studio Res, excuse me, Marriott has Studio Res. Many of the folks here on the stage, they have different brands. Is there space for all of this?
Absolutely.
Absolutely.
I couldn't say no more.
You laugh because the development guys are absolutely. But you know, you showed the slide. 10% of the overall supplies in the Tennessee segment. Now, if you were to break that 10% supply into economy, into the market, it's still a sliver. And, going back to your original question of why extended stay is so hot. So, Robert, we're having some technical issues here. We'll bear with you, Robert.
That's what we hear.
But, if you look, again, and I'll talk a little bit more about the extended stay, what made it so robust during the pandemic? Housing shortages, essential workers, right? All those things that kept our economy going, and also, unfortunately, a lot of people who've been displaced or in a period of transition in their lives, right?
Yeah.
That guest is expecting something different than someone coming to a homeowner estate. Yet, there's still great opportunities. I mean, our prototype for Echo and Wood Springs, somewhat similar, very different
Very much so.
than the other ones. We have 50,000 square feet, 124 rooms. Not much dead space there, all right? So, very true for Wood Springs as well. It changes as you go up.
Yeah, it does. I mean, for us, we had the luxury of having Home 2 Suites, who is about 12 years old now, Home 2 Suites, has performed so exceptionally well that it drafted up. So Home 2 Suites was created to be at about $115. I assure you, it's nowhere close to $115. It's more in the $135, $140 range. Homewood's in the $160 range. So for us at Hilton, we had this beautiful white space where we could create a product, Project H3, that would feed a need that we didn't have because we had priced ourselves up in the market. What we realized during COVID, and these guys have capitalized on it well before we jumped into the game, was this $300 billion workforce travel market. These are the folks that still travel during COVID. So think in terms of traveling medical professionals, insurance market, relocations, temporary housing. We weren't tapping into that at a price point that we needed to. So the creation of Project H3 for us was dictated by the demand of the segment in the marketplace. And that's a $300 billion segment. So we were all over it. But I do think there's space if you're disciplined to where you position your brand. Now, our expectation is that Home 2 will probably draft up. They all do. So what happens when Project H3 drafts up to $125? I assure you we'll be jumping into that space. Right? It's just a natural evolution of how you place brands within a portfolio. But there's plenty of space and there's plenty of business.
Yeah, and I'll just add, as one person on the stage whose company has not launched a brand or announced a brand in this space, what still gives me confidence in the mid-price is that Kenilworth Suites is a hugely successful brand over 25 plus years. They're also birthed by Jack DeBoer. We are already at the ADR that a lot of these brands are coming to the market trying to target. You can check out publicly available information. We're at $100 ADR. It's kind of right around where those workforce workers are willing to pay. So we've got a nice head start. We've got a lot of owners who have been excited about this product, and we have a lot of relationships with the types of accounts that want to stay at a Kenilworth Suites, and we're almost 400 hotels strong with a pipeline of over 100. I think another trend, actually, if we click up to upscale that we didn't talk about, that still means that there's demand. And this is somewhat antithetical to what we've just been talking about. Upscale extended stay brands flex very well to transit.
They do.
Right? So if you think about it, these are the brands that can most credibly compete with the Airbnbs and the Saunas of the world. Because what are those guests looking for? They're looking for space, they're looking for the kitchen, but what we have on them is consistency, right? And we have an actual guest experience and service behind it. And so we've seen, particularly, and I'm sure you've seen it in yours, Rick, in the most well-located kind of urban, first-ring suburb areas, that our Staybridge Suites do incredibly well. They maybe run a little bit less of that east line, but they make up for it, particularly on weekends. I mean, the same people, the sports teams, right, that want to stay Friday through Sunday and will pay you a lot of money, also want to stay at Staybridge, and not to demean my other brand, but you get a bigger room, you get a better breakfast, you get a lot more outdoor space. And so that's a demand driver that we can continue to find, particularly thanks to our IHG One Rewards database of members to kind of move them into Staybridge. And also something for you to consider as you think about the upscale part of the market.
Yeah, we recently introduced the Everhome Suites as our mid-scale brand. I think there's definitely room for more brands here. What really excites us most is choice. It's not just it's 12% supply per extended stay, but the demand for extended stay rooms is about 25%. It's about 2-to-1 coverage ratio.
When I opened my first hotel in 2002, extended stay bar. I won't say which brand, but extended stay. There were built them and they have continually to drive revenue. It's difficult to think about building anything else. And the market didn't need any more hotel rooms, it really didn't. And yet I'm running 91% for 20 years almost, in a market that has basically been flat for 20 years.
Yeah, I mean, it was interesting. We looked at our economy brands, Days Inn, Super 8, Travelodge. They were running a lot of extended stay business, without the facilities to do so, right? So, obviously that showed us. I mean, our developers wanted it, our global sales team wanted it, especially with an infrastructure bill, $1 trillion that's coming out. There's going to be a lot of money being spent on infrastructure, being deployed. And you're going to see many more, workers and those gray collar workers out there that are project-based, long-term projects. So, I'm not at all concerned about the number of grants that are coming or the number of rooms that are entering in the extended stay, because I still think it's relatively muted compared to the industry as a whole. I think what I would be concerned about is the discipline factor of hotel owners operating it the way it should be operated.
And that's a great point. And one of our questions that I wanted to move towards is a lot of the folks, before we talk who are the people that are coming into the market, a lot of the brands have requirements that if you have extended stay experience and you know how to operate, you've got good scores, you go to their new brands or build more and you operate. But often, and especially moving forward, people may not have that experience. So by brand, where do you stand on owners possibly without extended stay experience? What do you recommend them to do? Rick?
Yeah, so we built out an experience in Nashville. It's a great question, Doug, because our fear is that if you operate a home to or you operate a Homewood, it doesn't give you the experience necessarily to operate a Project H3, because the discipline is completely different. The average length of stay is 10 times that of a Homewood. So it's 30, 60, 90-day consecutive night stays as opposed to maybe 14 or 12 at Homewood. So we built out an immersive experience in Nashville. Our grand opening is September 13th. And we've got the Project H3's rooms there, but it's basically an owner orientation for the discipline of how to operate a Project H3 hotel. Because we felt the need to do that. I think it's a completely different discipline. It's a completely different operating model. And you have to be disciplined to execute against that. The only way we can safeguard that is to give owners the experience and training they need to operate it effectively. Because for a brand like Project H3, it'll be successful if the narrative is successful. But there is nothing worse than launching a brand and having the narrative go south. Because if the narrative goes south, the owner community is very tight-knit. So it behooves us to give them the education on the front end to make sure the execution on the back end is operationally sound, because then the narrative will be there. And I'm sure you guys do something similar, but
So
it's a completely
H3 is about brand support, with owners that still have experience with it. Staybridge may be a little different, Justin.
Yeah, and I'm actually going to answer that question from two angles. One would be, we wouldn't be a very good franchising company if we created a product that we didn't feel was relevant for as many owner types as possible. Right? We shouldn't make it so difficult to run with our support mechanisms behind it that we would close ourselves off from developers or people who want to convert to the brand. However, what Rick said is apropos. It does take some specialized training support models to make sure that owners are successful. Any of you who are IHG franchisees would know, if you go to our IHG owners conference, who are the people who are screaming in the room during the conference? It's the Staybridge Suites and Kenwood Suites owners and GMs and DOSs, because there's a special culture that's been cultivated over 25 years of leading these brands. And, for instance, I'm flying next week to go to dedicated extended stay summits that we have just for owners and GMs and DOSs, because one, turnover is happening all over the place. You all know that you own hotels. And so a lot of that secret sauce has to be continually reinstituted into people's minds. The way we support our hotels from, and I see some of my colleagues in the room, we'll call them out, the sales teams, the commercial teams, the revenue management teams, the operations teams are nuanced just for those brands. And so again, we'll happily talk to you about the brand, but we need you to understand there's going to be unique expectations when you sign that license, and you will receive unique support to be successful.
Because there's a lot of money in the market on the sidelines now, about ready to jump into extended stay. What's your viewpoint, though, Justin, on first-time owners?
First time owners, we will happily talk to you about it. Our FPS team will ask you a lot of questions during the deal stage about, do you have the stomach, do you understand the discipline it's going to take to go to this market? I know sometimes there may lead to a management company requirement at the start, just to make sure you're kind of getting your feet wet. Well, the other thing that I would look at in the deal structure is if you have other experience with other extended stay brands, right? So just because you haven't led one of our brands doesn't mean you don't have relevant experience within this large extended stay universe. So some of it, Doug, is the vetting at the beginning, asking the right questions, understanding why. Have you run your transient product the right way? That means you have the ability to switch over to extended stay. And then a lot of it is just trusting that together we all want to do the same thing, which is make money from your hotel, and that you, Mr. and Mrs. Owner, are going to follow the rules.
I would say the brands are your best friends when it comes to site selection, vetting that, the franchise approval process, although it may seem laborious, it's for your own good, for everybody in the room, as well as for the brands themselves, the right owners, the right sites. Do you have the potential? Will it succeed? Because, and especially as these brands roll out new, they need to be successful for the brand's purposes as well. So they are your best partners, be that any aspect of development and even potentially in some cases financing, to kind of help you find your way. Can't do things for you necessarily, but to help you find your way.
You know, one area, Doug, that I don't think we mentioned, but I'd love to get the perception of the perspective of the team on the stage here is dual brands have become quite prolific. So if you think in terms of Homewood, 22% of Homewood's pipeline is attributed to a dual branded asset. The same is true for Home 2. We are struggling with Project 83. Would you dual brand that from the start, or would you want to be specific to the prototypical nature of the brand? But that complicates matters, obviously, if you're operating two assets, but it's becoming quite popular in the marketplaces. So.
Yeah, no doubt. If you look at our mid-market extended stay Hawthorne, 95% of the pipeline is part of La Quinta. Right? We have about 60 under development right now, and they are all dual brand with La Quinta shared amenities. Right? Share, it really does drive some better profitability because your base business off of that extended stay that's high margin, and you have fewer rooms to fill on that transient upper mid-scale La Quinta piece of it. But I do want to go back to something about the ownership. And I think you said it great about not poisoning the well, not poisoning the narrative when you launch a new brand. It is so essential that you set the right expectations, and how we would work with someone entering the industry for a mid-market extended stay is very different than how we launched Echo. And we only launched it 15 months ago. We took the approach of really assembling those in this industry who have already been successful in this segment. And we listened to them. What would you create, both of the prototype and the operating model, in order to ensure that we launch this in the right markets, with the right operations and the right developers. And as a result, we now have 265 committed to, should be opening up about 15 to 20 next year. But it's different in the economy segment. And I would tell our most successful La Quinta owner who owns Hamptons and Courtyards and Holiday Inn Expresses to really change their perspective of what they're going into when they're going into economy extended stay. Because I don't know if we're allowed to say this, I don't say this for my company, but they're here, it is more like short-term rentals in the economy extended stay segment than it is like hotels. And if you don't go into it with that perspective, you'll have great margins, you'll have good margins, but there won't be the margins that you should have.
Sales marketing years ago was turn on the vacancy sign outside. And that's all you did, and you filled up. It doesn't work today. And especially if you get very defined segments, there's a completely different aspect where the brands can help in so many ways.
I think the best advice a brand can ever give you is where not to build an extended stay hotel. Because if you build the right location, there's demand drivers there, odds are with any brand you're going to be successful. So that's one thing we're really careful of. We don't have a lot of problem hotels because we're very careful in front end. We do site selection. We actually have a real estate team that helps people locate sites and opportunities. So that's something we definitely do. As far as dual brands, we do have dual brands, and there's an upside there too. But there are some owners who would advise you strongly against not doing a dual brand because their fear is the more you dilute your extended stay with transient hotels, the more you lose the competitive advantage of extended stay. So that's kind of, if someone's asking me the question, I would push them more towards purely extended stay, that way you can really focus on what you're doing. It's kind of old, the house divided can't stand, so we like to focus on stuff.
Pierre, I love this conversation because dual brand, similar to you, we have the same trends. My two extended stay brands are most represented in the dual brand combo. That's been helped by the fact we launched a prototype that matches Candlewood Suites with Abbott Hotels, which is IHG's new construction only mid-scale brand. And it's still early days, so I actually am really interested to see how that product performs. The hypothesis that you have is, as an owner, you kind of have to have a total hotel view of revenue. And it may mean the extended stay side is what pays the bills, but the transient side is what gives you the upside, right, in terms of total hotel revenue. But just simply thinking, I used to work on Wall Street. We used to tell our clients the best way to maintain value is diversification. And so if you've got two different brands, the access to demand drivers is a lot greater. I think the other point, which I love, which is about the importance of location and access to demand drivers. That's why looking at brands that may be conversion friendly is also important. Because you may not be able to put new construction in, and there may not be the best pile of dirt to do it. And so something we've been working on, I'm sure you all have too, Rick, at Hilton, is how do our extended stay brands work in existing hotels? We figured out how to put Candlewood Suites into a traditional, 12 and a half, 13 foot wide bay. Because actually our rooms are smaller than, say, a Holiday Express bay in terms of square footage. We figured out how to put Staybridge Suites in certain larger kind of big boxes and great micro locations, but the hotel was built 25, 30 years ago, and the market's kind of changed. We figured out how to put Staybridge Suites maybe into those hotels. And so another thing to think about if you own assets or have access to assets is whether they can convert to extended stay product, because it's a complex transformation, particularly because of the MVP that needs to be added for the kitchen stacks. But if you do it and you do it right and there's upside, you can have a pretty good value proposition.
Yeah, Choice has always been pretty good at conversions, and one thing we did recently, we took our Suburban Studios brand, and we had basically, Woodspring's a new construction brand. And so often we get a call, can we convert Woodspring Suites? The answer was no. So we did about 2 years ago, we went in, we actually replicated the Woodspring Suites opera model in Suburban Studios. And we've seen really strong demand, especially in the market with existing hotels. You might be in a market where you have a property, and it could be saturated with transient demand. And no matter how well you run that property, if it's a 15 to 20-year-old property, you may be at a disadvantage versus newer hotels. If you transform from transient into extended stay, you then get a competitive advantage, and you can actually become a market leader from an occupancy perspective. So we are really excited about conversions.
It's a great opportunity, but it's not as easy as it sounds. So all these things you know, so if you have a 20-year-old hotel and you want to put, a kitchenette in it, like to your point on the MEP, you're now going to have to go through permitting and bring that entire property up to current code, which is very expensive. So, it's
Gotta believe in the upside.
Yeah, it's not just throwing it in and hopefully they don't find out you put a kitchenette in. You have to get it approved, and everything in that hotel has to come up to code, current code.
Well, we've spent about an hour, talking. The other part of this session really is to have the audience ask questions, really any questions. I've left the financing part alone, but we can talk about that if there are questions about it. So let me go to the audience and see whether you want to direct a question specifically to any one of the panelists, or just in general, we can have an opinions review. So on the extended stay segment in general, does the audience have any kind of questions you'd like us to address? Please. One second, we'll get to it, Mike.
So Greg and I, I'm surrounded by Greg, so Greg on my court side here, represent an unassuming little company out of Wichita that started Residence Inn and then Summerfield and Candlewood and Woodspring and now Waterwalk. So Rob and Justin, you're welcome for Woodspring and Candlewood respectively, and David and Justin, it's not your luck to get on the bandwagon. But my question is more about, just with this plethora of brand launches, and some are represented here, some are not, what are you guys doing individually or, to differentiate both from a guest perspective and an owner's perspective?
I'll take that on. Well, I'll take that on in the economy segment. So we launched Echo, which is economy extended stay. If you look at Wyndham, we have 6,100 hotels in the U.S. About 60% of those are in the economy mid-market spaces. Economy is in our DNA, all right? So when we look at the economy extended stay space, you have to be true to what economy is, so it doesn't drift up. Because when it drifts up, what else drifts up? The cost of construction, the cost of operations. And so we've been committed to staying in that economy space. And when I look at the other prototypes that are being launched that are somewhat economy, maybe upper economy or lower mid-market, they're 60,000 plus square feet. The rentable square footage and revenue producing square footage, they are going to drift up, right? So I think we're good where we are, knowing what our DNA is, and having the product and operating model to stay there. You'll see more that will drift.
I would say with Everhome Suites, what we tried to do, we felt we had a really good master of the system with Woodspring Suites. So we said, enter the mid-scale, let's try to thread the needle. So what we want Everhome, we want it to feel like a mid-scale product for guests with the finishings and with the way the rooms look. But we want an operating model that can be as close to economy as possible. If we can have an economy operating model with a mid-scale feel for guests, we think that's going to be a really strong combination for our owners. And again, as I said from the very beginning, with extended stay, the reason it's been so successful, it's a segment that's good for guests but better for owners. So we always want to remember that we're doing this, as Jack DeBoer said, he's building hotels not for guests, he's building them for his investors. And that's the approach we took with the genesis of Everhome Suites.
At Project H3, I mean, we aligned with 5 specific owners who were also, they were very knowledgeable in the segment that we were not. And we did that to align ourselves to end up with a product that was spectacular. So we basically ended up with a product where the suite, or the revenue driving square footage within the building, 74% of it is revenue driving square footage, so attributed to the suites. The suites themselves, 316 square feet, is the king, and it's absolutely a stunning room. We over-indexed on the kitchen because our research indicated that 94% of the guests staying for that length of stay utilize the kitchen. So you better have a darn good kitchen. You better have a darn good bathroom area too, because those are 2 areas that they literally spend the time in. And then we took everything else away. Food and beverage, very, very limited. So a grab-and-go breakfast. The only reason we put a grab-and-go breakfast in is because many of the large major accounts, that's an indicator on an RFP process. Do you provide breakfast? Yes, we do. Come on, send us the RFP. But 2 areas that we doubled down on was one, the laundry facility. I was so tired of seeing laundry facilities on the 2nd floor at the end of the corridor with no windows. So we created in Project H3 a laundry mat. It is a great laundry facility. Again, a tremendous revenue driving opportunity for you as owners. And then the other side of the hallway is a fitness center that would be state-of-the-art. So great fitness, great laundry, a fantastic suite, a grab-and-go breakfast, but no other frills. So we created a product that we think is just phenomenal in the segment that we want to play in. So that was Project H3.
How do I follow that? Sorry, if you don't mind, I'll be very brief, because this is a great question. For Candlewood Suites, a lot of it is actually stay the course for the consumer. This is a brand that has worked really, really well since the very beginning. We do not offer breakfast intentionally. It used to get some complaints pre-pandemic from owners. Why do we have breakfast? Now I don't get those complaints anymore, because that's 1 to 2 FTEs you don't have to worry about. If there's any opportunity for us, it's actually learning from some of these other brands. It's the opportunity to increase the key count density in a new site, right? So looking at the room dimensions, because you all know this, we've been around extended stay for a while. The rooms for a while were very wide, starting with Residence Inn, to accommodate all the features that you need. And they've come from sort of 17 feet wide to 16 to 14 and a half, now 13. And so we're challenging ourselves to say, is there opportunity to improve density on the site for Candlewood Suites? Now, Statement Suites is really where a lot of the fun innovation is happening. You know, these are guests, and Rick said it, people are paying $160, $170, $180 a night. They're younger guests, they're more discerning. And so there's really a couple of trends that are happening that kind of collide with the guest and the owner. The quality of design is really important for these guests. And these are guests that would consider a premium transient product when they stay for a little bit longer and want. The quality of the design without spending too much on FF&E is important. And then F&B. That really is where Rick and I were kind of talking, sharing some notes. We had a reprieve for the pandemic of F&B innovation. I think that's over. They're paying $160, $170, $180 a night. And so breakfast, thinking about evolving your breakfast. We've done some work with our happy hour. We actually reduced this length to 90 minutes. We've got the cost down to $1 per occupied room for the guests, and it's still quite nice. But I think this F&B area, and really to improve flow through for the owner, monetize as much of the public area as possible, whether that's, you know, beer and wine things that are happening on Rick's brand, elevated retail, resident standards requiring bars going forward as a way of increasing flow through. That's where the innovation is going to happen on the upscale side. Sorry.
So I've been in the business.
Call on me, Doug.
Chuck, go ahead, my friend. Doug, you're gonna have to get up.
Doug wanted me to answer this question.
So I've been around for a long time. Sometimes you think you know the industry, and I think I understand as the more you all speak, I understand this more. But to me, as the brands open so many different categories, for me, who's in the industry, it becomes so complicated to understand which they are. And I often wonder, does the customer understand all of these different brands and how they understand? And are they loyal to these new concepts, or are they loyal to a Hilton or a Marriott, and they're just seeing what you have in that city or whatever, and that's where they're going to stay? So I'm just curious, the first question is, do customers really understand all of these brands? And I'm guessing you do it, and they do, but I'm going to...
I think the person who can answer that are the developers. Because you see brands that are launched that aren't developed, or maybe one or two are developed. And the success is really the narrative of the success of those developers and investors. Yes, there's a lot of brands out there, especially in the lifestyle segment. That was really the craze 5, 7, 10 years ago. And you see some of them that have launched, have expanded to whatever you want to call critical mass, and others that have not. So if their brands aren't being developed, I think that answers your question. If those brands are successful and grow, that answers your question as well.
And some people clearly are brand oriented, but a lot of these new economy brands will not be affiliated with the points program. Okay? And because there are hundreds of millions of loyal guests to each one of these brands, they will be communicating their own brands on a constant level to people, as well as publicly as you can. So in time, people will have a sense for what you get versus a variety of brands. And they may choose to go along brand lines, or see the experience, want to duplicate the experience, and begin to have loyalty towards a Candlewood or an Echo or any one of the brands, because they really do have different offerings.
So, I love your question. Because traditionally, these brands have been fueled by the quality of your sales operation. Either it's the BOS, it's some of the mid-scale and above brands who's out there pounding the pavement, tracking down leads, making sure that you're finding that extended stay guest, or it's the above property folks back at corporate are doing that kind of on your behalf. I do believe there's going to be more of an advertising battle now. And spending your owner system fund assessments on more marketing than we probably have traditionally done in this segment to convince more guests to understand those differences, either by the brand or by the brand company. So the power of IHG, Hilton, Marriott, Choice, et cetera, Wyndham, et cetera. So it's going to be very interesting as these brands that these lovely companies have launched at scale, whether the advertising model starts to change and you're doing a lot more, everything from TV on down to buying keywords on Google, whether you're seeing companies dedicate a lot more, because traditionally we've gotten by on spending a lot less of traditional marketing dollars to fill the funnel. So we won't have an answer in a year, but in 5 years, it'll be really interesting to sort of see, as an advertising guy, am I having to build the case for much bigger campaigns to support my brands than I ever have before?
Yeah, for a long time, the demand was so strong, you really didn't need a lot of advertising, because if you opened up down the red location, the guests would come. So I think a big question going forward is, traditionally, you've seen an inverse correlation between rate and length of stay. The higher the rate, the lower the stay goes. So as you see some of these rates people are talking about, you wonder if they get down to the smaller lengths of stays, is it really pure extended stay? There's a term that we use internally at Choice called casinos, which is extended stay name only, where they're called extended stay hotels, but they operate so much more like a transient. They're really not the pure extended stay and don't offer all the competitive advantages that the extended stays have for the owners previously.
And Doug, just to give you a statistic to back this conversation, for Home Suites and Home 2 Suites, about 78% of the revenue that comes through each of our individual brands is attributed to the Honors program. And Project H3 will be part of the Honors program, but it's going to be customized so that the guest that stays for a long period of time will be bonused based on 10-night increments. So we will literally reward you for staying the way in which we would like to have you stay for the brand.
Hey, we did something like that on our loyalty program.
Well, you know,
It's all good. It's all good. It's a great idea.
and I thought we came up.
So it's interesting because with our brand, Twin Springs and Echo, we made the decision, and you have a huge loyalty program, we have a huge loyalty program. We made the decision, Echo is not going to be on our loyalty program. Now, why would it not be on your loyalty program? For two reasons. The guest who is staying with us for an Echo for an extended period of time, 14, 30, 60, 90 points, they're not looking to pad their points. But more importantly, we don't want our owners to incur the costs of a loyalty program. And that's really what it comes down to.
There's a balance between all of this that makes it for the right property, the right place for the right owner. Then we'll make it different, so you will have choices to choose from.
Chuck.
Thank you, Doug, I appreciate it. Rick, this is directed to you initially. You made the comment that it takes a lot of discipline to operate the extended stay product and not drift into the transient market. And in a lot of the research we have done in strong downtown markets like Austin, Texas, or Nashville, you have an extended stay product, whether it be a Homewood or a Residence Inn or a Woodspring or whatever. The market in that downtown location is so strong for the transient demand, the operator has a difficult time, particularly when he's speaking to his owner, when he knows he can get $400 a night on a transient 1 or 2 or 3 night stay versus $175 on a 7-day or a 12-day stay. How do you justify that in a strong downtown urban market?
Yeah, so we used to, back in the olden days when I had hair, way back when, we used to dictate what we perceived as being the right extended stay number. So we used to say 50% SOP is the right number, and it's the right number in 539 locations across the world. That's not the answer today. The answer is you understand the optimization of your specific hotel based on your specific hotel and your market. But what I would say, Chuck, is we spend a lot of time talking about extended stay. Extended stay at the wrong rate is wrong. Extended stay at the right rate, you'll take 100% of it, literally. You literally would. And if it's at the right rate, the problem is if you make a mistake on pricing a piece of extended stay business, you've got to live with it for a long period of time. If you make a mistake with a transient room, maybe 1 or 2 nights. So we don't dictate it anymore. We spend a lot of time working with hotels to analyze optimization within their specific models, lots of displacement tools to analyze the fact whether or not you would be more valuable as a heavily transient asset with a sprinkle of extended stay, or heavily extended stay with some high-rated transient. But they don't dictate that.
As an example, Chuck, we have a property in Irvine, California. And seasonally, we change our ESOP from as low as about 28% up to about 71%. Optimizes for us, because we also take a look at years of turndowns, years of missed opportunity, so that when we look forward, we can blend it properly with the right level of ESOP at a certain rate, and then transient demands in order to build the most optimal level of revenue and profit.
Yeah, I would just say what you're saying is revenue management has become even more important for those, particularly on the upscale side, those well-located hotels in urban and kind of first ring suburban. And Rick's spot on, like the 50-50 model can work oftentimes in those hotels.
Hey Doug, do you mind if I put someone on the spot here, Mr. Hunter, who's there looking at his hotel, looking at his cell phone there? I'm curious, listen. I know, so actually that's what I wanted, so one thing we didn't touch upon was, especially in the economy segment, one of the knocks against economy extended stay was the cash cow, but what's the exit strategy? Can you talk a little bit about what you've seen in the trading of extended stay, whether it's economy, all the way to upscale, and how has that changed in the last 3 years?
No.
This anticipation is killing us.
This better be good after
I know,
that. This better be showstopper.
Mr. Hunter, we can hear you.
I'm pretty loud anyway.
Whoa, that works. What I can tell you is coming out of COVID, that's when extended stay as a product proved itself. And coming out of COVID, every extended stay product we were selling, and we were selling a lot for Blackstone. We're selling a lot of extended stay America assets. Blackstone owns the brand, so we were selling a lot for Blackstone. And what I could tell you was we couldn't sell it fast enough. And what was happening was we were selling regionally, right? 10 assets in Georgia, 20 assets in Texas and Oklahoma, 15 assets in California. We were selling them to the large owner operator in those markets. Interestingly enough, and all due respect to my friends and respective brands, it was developers who had built Hilton and Marriott and IHG branded and Hyatt branded select service assets, had either refinanced those assets or disposed of those assets, put a bunch of cash in their pocket. They took that cash and they went and they bought extended stay assets. So they were making the money on the development side of this equation. They were retaining the money by investing in extended stay assets. Fast forward to today, those big buyers, the market's changed. The Newcrest Images of the world are no longer buying 15, 20 extended stay assets because the debt structure has changed. We're still selling a bunch of extended stay assets, but given the current debt markets, the buyers for those assets are, the owner of the select, they own 5, maybe 10 select service markets in the region, and then they're going to come in and buy 1 or 2 of these extended stay assets because they can get financing through their local lender. The smaller asset deals are getting financed today, the big portfolio deals aren't.
I think there were also 2 really big transactions that kind of changed the marketplace. When Joyce bought Woodspring Suites, Brookwood bought 109 assets that were corporate owned for about $750 million. And 4.5 years later, they sold those for $1.6 billion. They basically doubled their investment within 4 years. And I think we've seen several trades. I think hotels maybe at 8, apartments at 4. If you have a stabilized cash flow, extended stay, you see a trade about 6. So the cap rates were really attractive. And we like to say, the only thing really more demand in terms of extended stay, not just the guest demand, but there's so much investor demand for the space as well. They want the stabilized return, it's resilient in cash flow.
Well, and if you think about things like burning off guarantees, you get a much higher coverage ratio with extended stay. So if you have to guarantee a construction time, you'll burn it off probably within 12 months. You get rid of your guarantees. Now, I'm not speaking on behalf of any lenders per se, but the margins are such that the coverage ratios are high enough that it really is not the general hospitality business. This is the money-making machine business in a way. Now, you can ruin it by trying to operate it like a regular building service property, but if you follow the basics, you listen to the brands, you go to the training, this is not nuclear science. It's about hospitality for the guests for their specific needs. Any more questions from the audience? I know we went way over, but William said we'll go as long as people have an interest to ask questions and continue. Yes, ma'am.
Good morning. Yeah. Laura Marmontel, I'm the owner of the Travel Lodge here at Memphis Airport. I just wanted to talk about, like you said, the interest rates that have changed the profile of people who are buying extended stays. Those interest rates have also been hurting people who want to convert regular hotels into extended stays. What are your recommendations right now on where to look in order to find loans, financing for conversions? i.e. I'm looking for one and struggling.
I would say one way that Choice Hotels is stepping in to help that is we are providing some key money incentives for conversion from transient to extended stay hotels. We'll try to give an amount of money that will offset some of the costs. We have a program called Kitchen in a Box where you can buy the supplies and convert a hotel. So we will partner with our developers with key money as one way to offset the increased cost of financing.
But there is no easy way around the fact that financing is very difficult in the general hospitality business these days. Anyone that tells you different is probably paying cash. You know?
It works.
You know, well, you're thinking about the dynamics of buying cash without debt on an extended stay, still will give you 10 or 11% cash on cash return. Well, and so for a diverse portfolio, people with a bunch of money, 10% really safe security is not a bad investment, and then you reinvest or you get your loans when the interest rates change. So get back up to the 17, 20% or higher percent cash on cash. Yes, ma'am.
David mentioned that 95% of your Hawthorne.
Could you speak a little louder, please?
David mentioned that 95% of your Hawthorns are dual branded going forward. Can you explain more how you see profitability running two under one building versus running the whole thing as extended stay?
Yeah, so it was interesting. When we first came out with our dual brand prototype for La Quinta Hawthorne, the La Quinta was, say, 80 rooms, where the Hawthorne would be 45 rooms. What you're now seeing is that number of Hawthorne rooms is coming up to 50, sometimes even 60. Now, even with just the 40 Hawthorne rooms, we still have the efficiencies that any dual brand would have with one general manager, one director of sales, shared lobby space, shared amenities, and it still gave, one could argue, better profitability than just having 100% transient. Now you're able to capitalize off two different segments, two different markets, right? With that 7-night stay at the Hawthorne driving that margin. Now, will the ADR be as high? No. That's what you're going to drive with the La Quinta version, or whether it's a Hampton True, Mainstay, Comfort Inn. It's always the same sort of argument to do it. It's, but again, I don't see. I was going to make an El Camino joke. Is it but I choose not to go there.
So which do you see greater, your extended stay room count or your nightly room count?
No, it's still the transit in the markets that we're going in. Still the transit La Quinta is going to have more room count than the Hawthorne. Because there still are markets out there where we would not build 124 room echo, right? But it doesn't mean that there isn't sufficient extended stay demand where you can't have 40, 50 rooms.
Additional questions for the panel? All right. Panel, thank you very much for your time. I think you're welcome. We'll stay around for a few minutes if anyone has any individual questions, but before you go, let me just make a quick plug. You have a piece of paper in front of you for the Extended Stay Lodging Association. It's a new association that was formed last year that was launched at the Hunter Conference, and it is made up of owners, developers, brands. And what's interesting about this organization, A, it's nonprofit, B, it's peer-to-peer. So I can talk to you as a owner about P&Ls. I can talk to you about what I make, what I spend, how I do my development, as well as other owners within this organization, that the brands are restricted from doing so because of the FUD. Okay, there's certain government guidelines which refrain them from making what are called earnings claims.
So I invite you please to look at this. It's esla.org. It may be something that's right for you as a developer or owner or someone that's interested in learning more about the extended stay business. In addition, anyone that signs up now, their membership is good through 2024 as well. So regardless of the time of year, it's really going to take you through till next year. So we've got a lot of brands, a lot of major developers, a lot of large management companies in the organization, and I think we're here to help others on a strictly educational basis. AHLA is a fabulous organization. They advocate for everybody. We don't. We're about specific training and peer-to-peer. What did you do? How could we do it better? You know, what brands did you go to? We gave you support. Peer-to-peer, we can talk about a lot of things. And we'll also may funnel to you to the various new grants as well. So thank you very much for that, Doug. I appreciate it.
Thank you, Doug.